Avery Sheffield is with us. VantageRock co-founder, CIO, and senior portfolio manager. Good to have you.
Great to be here.
You care who the next Fed chair is?
I think well, let's see. I think over the longer term it matters. Under the Trump administration, the next Fed chair, I think, is going to be, chosen to be as compliant with Trump as the markets will allow that person to be. So, yes, I think if Trump does pick someone who would have more independence, I think that the markets would probably respond better to that, feeling like they're making the right longer-term decision.
Don't we think, though, that he's more likely? Everything is speculation, of course, but just judging by his own actions and his own language, that would, in and of itself, suggest that he wants somebody who's going to advocate for cutting rates.
No, absolutely. That's what I'm saying. He wants that, and he wants someone who will cut rates a lot. The question is, will the market allow him to do that, right? Because the bond market might push back. It actually has pushed back when there have been suggestions of very significant short-term rate cuts on the long end of the curve. So, yes, he wants that. He thinks the long end of the curve would come down with the short end, but if the bond market reacts differently, that might impact his decision.
How do you think the Fed factors into whatever the market's going to do for the remainder of the year?
So I think the market reacts best when the Fed reacts appropriately to the economic data. And as of now, it seems like the Fed is looking carefully at the risks on the economic side, balanced with a potential acceleration of inflation from tariffs coming through. And so at the moment, from the data I'm seeing, the economy is starting to weaken. The revisions we had to payrolls last week suggested weakening. We have weak construction spending. We have the Challenger layoff reports. Actually, for the first half of the year, all of last year, we have corporate bankruptcies at a 10-year high in June. We have a lot of signs that we maybe should cut rates a bit. And yet, I don't know that they'll go strong with a 50 basis point cut because of the uncertainty about the impact of tariffs.
Do you think the market's vulnerable right here?
I do think that the market is vulnerable. Yes, I think we're seeing a lot of signs of that, right? We had so much froth build up from post-Liberation Day. We had the Bank of America fund manager survey, right, in July, had the fastest move up in the 3-month in the 3-month risk appetite that we've had since the survey began in the early 2000s. We've had a 5-month high on risk appetite. We have lots of meme-like behavior in the market that then is correcting. So those factors together suggest that there's actually a lot of bullishness. We also have cash levels into July at lows. So I think that does suggest that we have a lot of bullishness built in to a market, to an economy that is weakening and is expecting the Fed to bail us out.
Okay.
And that can be a tough needle to thread.
How do I want to, if I believe your perspective, and I'm listening, how do I want to express that in the market? If I feel like, okay, well, I believe everything that Avery's saying. I need a more defensive posture.
Yes.
How do I do that?
Yes. So I would take a more defensive posture through two means. First, I would really pay attention to valuation because we are seeing highly valued stocks really get pummeled on any slight misses. So valuation is mattering in the actions we're seeing. I expect that to continue. So I would look for less expensive stocks, but I wouldn't just look for less expensive traditionally defensive stocks. I would look selectively in defensive and selectively actually in cyclicals that could benefit from an economic recovery should the Fed, loosen out enough to stabilize things.
Good to see you. It's nice to have you. Avery Sheffield, thanks for reacting in real time to that news that we were following with Steve Leisman.